Have you ever felt like your student loans are a giant, scary monster chasing you through adulthood? You're not alone. Millions of Americans feel trapped by student debt. But here's the surprising part. There are repayment plans designed to help you breathe easier, and some of them can even erase your balance over time. But which plan is actually best for you? Stay with me, because by the end of this video, you'll not only understand the best student loan repayment plans, but you'll also discover one little-known secret that could save you thousands of dollars without you even realizing it. Number 1. Why your repayment plan matters more than you think. Picture this. Two friends, Sam and Alex, graduate with the same student loan amount. Let's say $40,000. Sam picks the standard repayment plan. Alex chooses an income-driven plan. 10 years later, Sam has paid off his loans, but Alex is still paying and has shelled out thousands more in interest. This happens every day because most people just accept the default plan without even knowing their options. The wrong plan can cost you more, hurt your credit, or keep you in debt much longer than you need to be. Choosing the right repayment plan is like picking the right shoes for a marathon. The wrong ones will leave you limping. Number 2. The standard repayment plan, the fastest way out. Let's start with the plan most people automatically get. The standard repayment plan. This one gives you fixed monthly payments for 10 years. If you can afford it, it's usually the cheapest option because you pay the least interest overall. For example, if you owe $30,000 at an interest rate of about 5%, your monthly payment is around $320. By the end of 10 years, your balance is gone. Sounds good, right? But here's the catch. That monthly payment can feel steep, especially if you're just starting out and your paycheck feels more like a suggestion than a salary. If you can afford it, great. But if you're struggling to make ends meet, there are better options. Number 3. Graduated repayment. Start low and grow. What if you like the idea of paying off your loans in 10 years, but your wallet isn't quite ready yet? That's where the graduated repayment plan comes in. This plan starts you off with lower monthly payments that increase every 2 years. So if you expect your income to grow over time, maybe you're in a field like law or tech, this can be a smart move. For example, if you owe $40,000, you might start at around $230 a month. By the end, you could be paying closer to $600 a month. It's still a 10-year plan, so you pay less interest than longer-term options. But it does assume your income is going to rise. So if you're unsure about future raises, tread carefully. Number 4. Extended repayment. Stretch it out. Here's another option if your debt feels overwhelming. The extended repayment plan. Instead of 10 years, this plan lets you pay over 25 years, which lowers your monthly payment a lot. For someone with $50,000 in debt, the monthly payment might drop from $530 to about $300. But, and this is important, you end up paying way more in interest over the life of the loan. So you get short-term relief at the cost of paying more in the long run. If you're really struggling just to get by and you don't qualify for income-driven plans, this might keep you afloat. Just know it's not the cheapest option. Number 5. Income-driven repayment. The safety net. Now we get to the plans that everyone should at least consider. The income-driven repayment plans. These plans base your payment on your income and family size, which makes them much more affordable when you're not earning much. There are a few different versions. Income-based repayment, IBR, pay-as-you-earn, PAYE, revised pay-as-you-earn, REPAYE, and income-contingent repayment, ICR. Each one has slight differences, but they all have the same core idea. You pay a percentage of your income, usually around 10 to 15% of what you earn above the poverty line. For example, if you're earning $35,000 a year with a family of 2, your monthly payment could drop to less than $150. And here's the kicker. After 20 or 25 years of payments, the remaining balance can be forgiven. That's right, erased. But there's a catch. Forgiven amounts are usually taxed as income. Still, for many people, this is a lifeline. Number 6. Public service loan forgiveness, the golden ticket. What if I told you there's a way to have your student loans forgiven in just 10 years? That's not a typo. And no, it's not a scam. The Public Service Loan Forgiveness Program is designed for people working in government or nonprofit jobs. If you work full-time for a qualifying employer and make 120 payments on an income-driven plan, the rest of your balance is forgiven. tax-free. For example, a teacher working in a low-income school might still owe $60,000 after 10 years of payments. But under this program, the balance is wiped clean. The key here is to certify your employment every year and stay on an eligible repayment plan. Many people mess this up because they don't file the right paperwork. So if you're working in public service, this is one of the best-kept secrets you can take advantage of. Number 7. Which plan should you choose? So with all these options, how do you pick the right one? Here's a simple way to think about it. If you can afford the standard plan, it saves you the most money in the long run. If you need a lower payment now but can handle bigger ones later, consider the graduated plan. If you need the lowest possible payment, look at income-driven plans. And if you work in public service, PSLF could save you the most. Think about your income now, your expected income in the future, and how much you care about paying as little interest as possible versus having a lower monthly payment. Here's a quick example. Jamie just graduated with $60,000 in loans and earns $30,000 a year. The standard plan would be more than $600 a month. Too high for Jamie. Instead, Jamie picks an income-driven plan and pays about $150 a month. If Jamie switches jobs later and earns more, they can switch to the standard plan anytime. That's the beauty. You're not locked into one choice forever. Number 8. The hidden cost of choosing the wrong plan. Here's where most people get blindsided. Picking the wrong plan can actually hurt your finances and even your mental health. People on extended or income-driven plans often pay much more in interest because they stretch payments out over decades. For example, paying $300 a month instead of $500 might sound good now, but over 25 years, you might end up paying $20,000 more. So don't just pick the smallest monthly number without thinking about the total cost. Number 9. How to change your plan. It's easier than you think. Good news. If you're already on a plan that doesn't work for you, you can change it. Go to the Federal Student Aid website, log into your account, and use the Loan Simulator tool. It lets you compare plans side by side and shows you your estimated monthly payment and total interest. Then, you can apply online to switch plans. It usually takes just a few weeks to process. For example, Sarah was on the standard plan but lost her job. She switched to an income-driven plan in about 20 minutes online and cut her payments in half. Number 10. One little-known trick that could save you thousands. You stuck around. And here's the secret I promised you. If you're on an income-driven plan and your income drops, even temporarily, you can recertify your income right away to lower your payments. Most people think they can only update their income once a year. Not true. If you lose your job, take unpaid leave, or even switch to a lower-paying role, you can request a recalculation anytime. This little trick can save you hundreds or even thousands over the year, and it can also keep you from falling behind on your payments. Number 11. Why auto-pay could save you money. Here's a super simple move that most people overlook. If you set up auto-pay on your federal student loans, you usually get a small interest rate discount, about 0.25%, for example. If your interest rate is 5%, enrolling in auto-pay could bring it down to 4.75%. It doesn't sound like much, but over years of payments, that can add up to hundreds of dollars saved. Plus, you'll never miss a payment and risk late fees or hurting your credit score. Number 12. How consolidation can simplify your life. If you have multiple federal student loans, you can combine them into one with a direct consolidation loan. This won't lower your interest rate, but it can simplify your life by giving you a single monthly payment. It can also help you qualify for certain repayment plans or forgiveness programs if your loans didn't previously qualify. For example, if you have old loans that aren't eligible for income-driven repayment, consolidating them makes them eligible. Just keep in mind, consolidating resets the clock on forgiveness programs, so don't consolidate if you're already years into PSLF. Number 13. Don't forget to recertify every year. If you're on an income-driven plan, you must recertify your income and family size every year. If you forget, your payments could jump back to the standard plan amount, and that can be a nasty surprise. The good news? The Department of Education usually sends reminders when it's time to recertify, but put a note in your calendar anyway, to avoid a financial headache. Number 14. What happens if you can't pay? Life happens. Sometimes you just can't make your student loan payments. If that's you, don't panic. You have options. You can request a deferment or forbearance, which temporarily pauses your payments. But keep in mind, interest usually keeps adding up during this time. So it's better to switch to an income-driven plan if you can. For example, Jake lost his job and paused his loans with forbearance. But when he started paying again, his balance was bigger than before. So use forbearance only as a last resort. Number 15. Private loans play by different rules. Everything we've talked about so far applies to federal student loans. But if you have private loans, those follow different rules. Private lenders don't offer income-driven plans or forgiveness programs. However, you can still call your lender and ask about options. Some offer temporary interest rate reductions or extended terms. For example, Mia refinanced her private loan with a new lender at a lower interest rate, which saved her thousands. So if you have private loans, explore refinancing to get a better deal. Number 16. Keep an eye on policy changes. Student loan policies change more often than you'd expect. In recent years, there have been big shifts in forgiveness rules, repayment options, and even interest freezes. For example, during the pandemic, federal student loan payments were paused for over 2 years. So stay informed by checking the federal student aid website or trusted news sources. Being up to date could save you from missing out on new benefits or programs. Managing student loans can feel like climbing a mountain, but the right plan is like finding a hidden trail that makes the journey easier. So now you know your options. Which plan do you think would work best for you? Share your answer in the comments below. I'd love to hear your story.